JJ here with the Art of Value. So today I want to talk about Peter Lynch. I looked at the market today. It's been on the slide pretty much for the first half of the year. One of the worst first halves ever, apparently. Maybe the worst, I don't know. But it was up today. We had a good day. So instead of talking about the market from day to day, I thought I would talk about Peter Lynch today and what some things Peter Lynch has said. One of the GOATs, one of the greatest of all time investors. And if you don't know who he is, he ran a fund, the Magellan Fund, for 13 years between 1977 and 1990, which is not a long career really, but he had a great run of almost 30%. I think it was 29 point something percent CAGR, compound annual growth rate. It was huge. He turned a fund that was $18 million into $14 billion. And he retired at 46, so really young when he retired. And he said part of that reason was that his father died when he was 46, so that's, I guess, understandable. And so he wanted to do other things, and you need a lot of conviction to do a fund, have a fund, and he just wanted to do other things. Obviously, he made a lot of money. But his book, One Up on Wall Street, if you haven't read that, it's worth a good read for new and experienced investors. There's always something in it. When I reread it, you pick up again and again. But there's this, he gave a lecture in 1997 and 94, was it? Hold on. It's a 1994 lecture, okay? And I'm just not, it's a long lecture, but there's just a few things in it that are relevant to the stock market today. I mean, it was a long time ago, a few decades ago, but there are, lessons to be learnt from all times. So I've just picked a few things out here to react to and talk about. So the first one is learning from history. Study history. It's important when picking stocks. You learn that the market goes down, he basically says. And once every 2 years, there's a 10% correction and something greater than that every so often. And it's good when that happens. So, it's a different way of looking at the market when we're day to day and it's down so much. Let's listen to what he has to say on that.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times.
All right, see, this market's going to go down. You have to expect it. And Charlie Munger said that the same thing. If your stocks don't go down every so often, Charlie Munger said if your portfolio doesn't go down 50% from time to time, you shouldn't own stocks. And he basically says the same thing. If you're not willing for the market to go down 25% or stocks go down 25%, don't own stocks. That's a good lesson from Peter Lynch there. So the next one, why people panic. Why do people panic? Sell stocks.
But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16 and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? Psychiatrists haven't worked so far. I've never seen them running in. The psychological psychiatry fund I've never seen listed for the with the SEC to make it through as a mutual fund. So
I'm going to just stop them there. So, the lesson is you've got to understand the company. I mean, yesterday I went through the earnings call of Micron Technology, and a couple of days before that I did another podcast on, the earnings results. So, all these things, the stocks that you actually own or want to own, to learn as much as you know about them. So when they go down 50%, you understand it. That you're ready for that. You say, oh, well, it's cheap now. It's really cheap. I'll buy some more. But if you don't understand the company, if you hadn't analyzed it, then you're not going to know whether that's cheap or not. Was it really expensive in the first place? Which I think has happened recently with emerging tech stocks that were trading at hugely high multiples.
they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about got back to its 1929 high when General Electric took it over. A lot of double knits never came back. Remember those beauties? Floppy disks, Western.
So yeah, also he's saying there, just so he doesn't get misinterpreted, stocks don't always come back. Some of those, for instance, some of those maybe innovation type stocks, emerging stocks that fell, went really high, fell. Some of those I think will never come back. Just my opinion, not financial advice. So you really have to know the company, you have to know the company well, and you'll know what price it is, or if they're going to come back. If it's like when Amazon dropped 90% during the dot-com bubble. People who've been know the fundamentals of the company, had been looking at it. As Jeff Bezos said, they saw the stock drop that much, but everything inside the company was pointing to good things ahead. All right, so the next one, I'm not going to make this a long video today. I've done a couple of really half an hour ones in the last few days on Micron and so forth, and on Stan Druckenmiller as well, if you want to go back and have a look at those. So the other one is, there is always something to worry about in the stock market, which is so true. And remember, this is decades ago.
There's always something to worry about. If you own stocks, there's always something to worry about. You can't get away from it. What happens in the 50s, people were worried about, the only reason we got out of the Depression was World War II. We got another recession. In the early 50s, they said we're going to go right back into a depression. People were worried about a depression in the 50s, and they worried about nuclear war. I mean, back then, the little warheads they had then, they couldn't.
So yes, that's familiar, isn't it? People worried about a war. There's a war on now. Depression. 2008, 2009, people worried about the economic system about to collapse. Again, there's worries about a recession. So there's always something, always something. And so the next one I want to show you is use your stomach.
The organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all.
That's it. Pretty simple. Sounds simple. Makes it sound simple. There's always something to worry about. It's always going to be scary, like now in the last 6 months. Also, one last one is he loves volatility. So let's see about that, because when the stock market's volatile, what does he say?
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these collars and all these other things, to keep the volatility down each day is important. But the market's...
See, that's the thing. We've had volatility lately in the last few months. Sometimes it's gone down 5%, up 5%. So people don't know where it's going, but generally you can take advantage of it.
It's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field and the market will go down or the market will go up. So volatility will occur and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try to figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced.
Okay, talking numbers back then, but basically it goes up over time, and he reiterates again, you've got to understand the company that you own, especially in volatile times when it goes down 50%. Was it worth 50% higher or not? I mean, was it worth 100% higher? If it goes down 50%, it has to go back up 100%, of course. So, but the more you understand the company and what it's worth, the better it'll work out. But basically, he's saying volatility is good because if it goes down, that's when you can buy. So I think all those things are really relevant even though it was the 1990s, still relevant today. Of course, that was before the dot-com bubble. And I think we've had a kind of innovation stock bubble recently, and also crypto, which is a bit more difficult to work out what that's worth. All right, so that's it for now. Like and subscribe your favorite apps again. Give us a like on YouTube for the algo, and join me on the Art of Value on Twitter. See you next time.